Okay, picture this. You've got a company that has absolutely conquered the globe. I mean, we're talking a massive footprint. It's operating in 29 countries, it's got over 500,000 paying customers, and some of the absolute smartest, most ruthless money on Wall Street has officially crowned it a $47 billion titan. $47 billion! It wasn't just pitched as a business, right? It was pitched as a revolution, a complete paradigm shift in how we live and work. And then, in just 6 weeks, it all evaporates. Poof. Gone. Just up in smoke. We are talking about the greatest financial illusion in modern history, completely unraveling in real time right in front of the entire world's eyes. But listen, here is the absolute most baffling part of this entire mystery, the part that really makes you question how the whole financial system works. As this multi-billion-dollar empire was crashing, burning, and just absolutely spiraling toward total bankruptcy, the architect of this disaster, the mysterious founder who steered the ship straight into the iceberg, he didn't go down with the ship. No way. Instead, he walked away with a staggering $1.7 billion golden parachute. Billion with a B. How on earth does that happen? How does a company literally lose almost all of its value, wipe out thousands of jobs, absolutely torch investor capital, and yet the guy at the top walks away a billionaire? Welcome to The Explainer. Today, we are diving deep, and I mean really deep, into the actual financial mechanics of the ultimate capitalist mirage. We're going to dissect an unbelievable saga of extreme wealth creation, bizarre corporate culture, and just absolute unchecked hubris. We're going to look directly at the raw data, the massive venture capital investments, and the exact moments where visionary leadership completely crossed the line into total delusion. Get ready, because this is a wild ride. Part 1. The $47 billion mystery. So to really understand the sheer magnitude of this collapse, you have to picture a company that successfully convinced the entire financial world it was an unstoppable technology giant. They were expanding aggressively across the globe, right? Buying up smaller startups left and right, everything from coding academies to office management software. To anyone looking from the outside, it looked like an absolute juggernaut. But under the hood, this giant was burning through cash at a rate that is frankly terrifying. We're talking an estimated $700 million every single quarter. $700 million. The top-line growth was super intoxicating, sure, but the underlying math was a horror show. By 2018, they were bragging about having 12,500 employees spread across 29 countries, serving 500,000 customers. But this massive, sprawling footprint completely masked a rapidly deteriorating core. The reality, a staggering $1.9 billion in losses. They were selling this flawless narrative of exponential tech company growth to investors, but the actual unit economics of the business were bleeding them totally dry. Part 2. Selling space as software. Okay, so the company, of course, was WeWork, and the enigmatic founder pulling the strings was Adam Neumann. Now, Neumann, drawing heavily on his time living in an Israeli kibbutz, launched the very first WeWork location back in 2010. And get this, it was in a rundown Soho building in New York that, incredibly, previously housed an S&M dungeon. You can't make this stuff up. But Neumann didn't pitch WeWork to the world as just a place to rent a desk. That's boring. He pitched it as a movement, a physical social network, a tech company that was on a literal mission to, and this is a direct quote, elevate the world's consciousness. And the crazy thing, venture capitalists totally bought into it. They bought this software as a service or SaaS narrative, and they started assigning WeWork massive tech multiples. Now, if you know finance, you know tech companies trade at these huge multiples because software is incredibly cheap to scale. Once you build the code, adding a new user costs basically nothing. But WeWork, in harsh, undeniable reality, WeWork was a commercial real estate company. That's it. They were signing massive, long-term commercial leases, slapping on some cosmetic upgrades, some neon signs, some glass walls, and then subleasing that same space out on short-term, flexible agreements. That is a notoriously high-cost, incredibly low-margin business. We are talking gross margins in the 26 to 28% range on a good day. So this whole tech unicorn valuation was a complete and total mismatch for a company carrying tremendous physical overhead and absolutely massive multi-decade lease liabilities. To understand exactly how the valuation spiraled so wildly out of control, we have to look at their aggressive blitzscaling strategy. Blitzscaling is basically when you prioritize speed over efficiency to achieve massive scale really fast. So from its humble founding in 2010, watch this trajectory. The valuation skyrockets to $1.5 billion by 2013. Then, boom, $20 billion by 2017, and then an astronomical $47 billion by early 2019. They were just dropping absolute bucket loads of investor capital on major cities worldwide to acquire market share at literally any cost. Institutional players, the smart money, right? Guys like Goldman Sachs and Fidelity were throwing cash at them. But you have to realize, this wasn't organic, profitable growth. This was a valuation artificially bloated by relentless, aggressive, almost desperate capital injections. Part 3. Enter the Vision Fund. So to keep this insane blitzscaling engine running, WeWork needed capital. Unprecedented, historically massive amounts of capital. Enter Masayoshi Son and SoftBank's legendary $100 billion Vision Fund. Now, the Vision Fund was specifically designed to deploy massive blue-chip checks in Silicon Valley. But here's the thing about finance at that scale. Deploying $100 billion is actually really hard, and the immense pressure to move that much capital can sometimes blind even the most seasoned, brilliant investors to fundamental business flaws. SoftBank's team did tons of diligence, for sure, but at the very top of the food chain, large checks are often written based on pattern matching and pure gut instinct. During their very first meeting, which, by the way, reportedly only involved about 4 minutes of direct interaction between the two men, Masa-san asked Neumann a fascinating, revealing question. He looked at him and asked, in a fight, who wins, the smart guy or the crazy guy? SoftBank then proceeded to drop a massive $4.4 billion investment into the company in 2017, and they later added billions more. This jaw-dropping validation from one of the world's largest tech investors sent Neumann's hubris into absolute unchecked overdrive. Masa-san even publicly compared WeWork to Netflix and Facebook. He was seemingly fully embracing the greater fool theory, which is the gamble that you can buy into an asset at an inflated price simply because some greater fool will come along and buy it from you for even more later on. But okay, let's step back and look at the raw, unforgiving financial reality for a second. For all the big talk of being the next Facebook, here are the hard, cold numbers for 2018. Revenue, $1.8 billion. Losses, $1.9 billion. Think about the math there. For every single dollar WeWork made, they lost more than a dollar. Under their current hypergrowth model, profitability wasn't just difficult, it was mathematically impossible. You can't lose money on every transaction and make it up in volume. Yet the venture capital just kept flowing in, completely untethered from the actual reality of the balance sheet. Part 4. Building a capitalist cult. As the financial hole grew deeper and deeper, the internal corporate environment at WeWork became increasingly, detached from reality. They weren't just operating as a real estate business anymore. Adam and his wife, Rebecca Neumann, were building what can really only be described as a capitalist cult. And it was all masked by this lofty pseudo-spiritual mission of elevating the world's consciousness. Listen to some of these stories because they are wild. In 2016, they had to do these painful layoffs, cutting 7% of the staff. Moments after announcing people were losing their livelihoods, employees were carrying trays of tequila shots into the room, followed by a private surprise concert by Run DMC. I mean, what? Rebecca Neumann reportedly had mechanics for their private jet fired simply because she felt they had bad energy. No performance review, just bad energy. They hosted these mandatory corporate summer camps where thousands of employees were essentially tracked with wristbands. And in a bizarre, sweeping corporate decree, meat was entirely banned in the office. This wasn't just your quirky, typical Silicon Valley startup culture. It was a highly toxic, erratic leadership style that weaponized energy and pseudo-spirituality to enforce absolute, unquestioning loyalty. And while the core real estate business was literally hemorrhaging cash, the reckless diversification went into absolute overdrive. Millions in investor funds were siphoned off into staggering vanity projects. I mean, they bought a $60 million Gulfstream private jet just for Adam and Rebecca to travel in. They bought a massive 42% stake in a wave pool technology company. What does a wave pool have to do with co-working spaces? Nobody knows. And most shockingly, Rebecca launched WeGrow, an elite holistic elementary school where tuition cost up to $42,000 a year. The focus clearly wasn't on fixing the $1.9 billion operating loss. It was on funding a billionaire utopian lifestyle straight on the company dime. Part 5. The S1 implosion. So by August 2019, the music finally stops. Private investors are finally tightening their purse strings, and WeWork has absolutely no choice but to file for an initial public offering, an IPO, just to raise the cash they need to survive. So they released their S1 registration document. Now, as Warren Buffett famously said, only when the tide goes out do you discover who's been swimming naked. Well, the S-1 filing was the exact moment the lights were turned on and Wall Street finally saw exactly what was hiding in the dark. And let me tell you, the disclosures contained in this document were absolutely jaw-dropping. First, you had this highly creative accounting. Instead of standard GAAP financials, WeWork presented a metric they actually invented called Community Adjusted EBITDA. This metric was so heavily engineered, it basically ignored all of their actual fundamental expenses. It was basically earnings before all the bad stuff. Then came the blatant conflicts of interest. Get this. Neumann had personally trademarked the word we and actually charged his own company $5.9 million just to buy the rights to use it. He sold the word we to WeWork. Furthermore, he had been privately buying commercial buildings and leasing them right back to his own company. NYU professor Scott Galloway hilariously noted that the document read like it was typed by someone on shrooms. The broader market read this, totally panicked, and immediately revolted. The IPO was dead on arrival. So you really have to ask yourself, how on earth was this allowed to happen? And it all comes down to severe, catastrophic governance failures. The board of directors, which included highly sophisticated representatives from major investors like SoftBank and Benchmark Capital, completely and utterly failed to implement basic checks and balances. Neumann had structured the corporate shares so he held a massive, untouchable majority of the voting rights. He could do whatever he wanted. He appointed family members to high-level executive roles. Investors were just so desperate to ride this unicorn rocket ship to a massive payout that they willingly surrendered all their oversight, validating Neumann's totally unchecked power every step of the way. Now, what this entire saga really represents is a fatal disconnect. Look, you absolutely need visionary leadership to scale a company quickly. You need that reality distortion field. But you critically, fundamentally need operational discipline to make that company actually survive long term. Neumann's sheer charisma could attract billions of dollars, sure, but his arrogance, hubris, and erratic leadership destroyed any actual chance of building a sustainable, mature company. He fatally mistook the ability to raise venture capital for the ability to actually build a profitable business model. And those are two very different things. Part 6, the billion-dollar parachute. So what happens when a $47 billion bubble finally pops, the IPO is officially pulled, and financial accountability comes knocking at the door? Well, the aftermath of WeWork is perhaps the most stark, sobering illustration of how modern venture capital protects its elite while leaving literally everyone else to pay the ultimate price. 2,400. That is the number of regular, everyday WeWork employees who were fired in the immediate, devastating fallout of the IPO collapse. That was nearly 20% of their entire global workforce, just wiped out, while the executives who orchestrated this historic disaster sat in fancy boardrooms negotiating their incredibly lucrative exits. The everyday workers, the people who had actually bought into the energy of we and often accepted much lower base pay in exchange for stock options that were now completely worthless, they were left out in the cold with absolutely nothing. And the company itself, it entered this agonizing, drawn-out downward spiral. By the time WeWork finally managed to actually go public in late 2021 via a SPAC merger, it was valued at a mere $9 billion, a tiny fraction of its peak. But the underlying massive real estate lease liabilities, they were a ticking time bomb that the pandemic only accelerated. The math still just didn't work. Empty desks, but the rent was still due. By November 2023, the once $47 billion Titan officially filed for Chapter 11 bankruptcy. It represents a staggering 99.97% wipeout from its peak private valuation. Just total destruction of value. SoftBank, the primary enabler of this massive financial bubble, was ultimately forced to step in and effectively bail out the company just to try and stabilize the collapse and save face. Masayoshi Son and the Vision Fund ultimately had to write down over $10 billion in staggering losses related to their WeWork investment. $10 billion. It was a brutal, multi-billion-dollar lesson in the real-world consequences of funding grand vision over sound, boring financial fundamentals. But wait, because here is the most insane part. While the company imploded and thousands lost their jobs, look at where Adam Neumann ended up. To get him to step down as CEO and relinquish his super voting rights in late 2019, SoftBank basically had to pay him off. They paid him nearly $1.7 billion. He got $970 million just for his shares, a $185 million consulting fee, whatever that means, and $500 million to repay his personal bank loans. He even got to keep roughly 10% ownership of WeWork. Unbelievably, during the bankruptcy proceedings later on, he actually tried to buy the broken company back for $500 million. And, if that wasn't crazy enough, in 2022, the legendary Silicon Valley venture capital firm Andreessen Horowitz handed Neumann $350 million for a brand new real estate startup called Flow. I mean, seriously, Despite orchestrating one of the greatest, most spectacular corporate value destructions in modern economic history, the financial system rewarded him with unimaginable wealth and handed him the keys to do it all over again. It leaves us with a really stark, deeply unsettling reality about the modern investment ecosystem. The WeWork saga wasn't just a failure of a single erratic founder. It was a massive, systemic failure of an entire class of supposedly brilliant investors who were just too eager to buy into an illusion. So I'll leave you with this. Can raw charisma and a compelling story ever truly replace basic financial fundamentals? Or are we all just waiting around for the next charismatic visionary to sell us another $47 billion mirage? Let that thought sink in. Thank you for joining me on this explainer, and I will catch you on the next one.